Hey everyone, we have a crazy week of earnings coming up ahead of us here. So, really looking forward at doing a quick breakdown of what stocks are reporting each day this upcoming week, highlighting some of the key earnings reports that I see in the market. We're going to have a good time in this video going stock by stock, talking what their risk reward is to the upside, what their risk reward is to the downside, what stocks I am more interested in than others, and some interesting storylines we have and earnings per share estimates we have on some of these stocks throughout the week. Before jumping into this, if you don't mind giving this video a big thumbs up, it really does help me with the YouTube algorithm being a smaller channel. So, really appreciate you just taking a second to hit that before getting into this video. Okay, starting on Monday. So we have a bunch of regional bank type stocks reporting Monday. You see First Bank, Guarantee Bank, and Trust. I'm assuming you call that Cross First, Home Bank. To be honest, given what's going on in the rest of the week, I'm really not too interested on Monday on these names. It'll be interesting to see if they feed the narrative that was set on Friday by some of the other big banks in the US, but overall, don't think they're going to have an overly large impact. So we'll probably just take a peek on how the market reacts, but not overly interested to any of the action going on Monday. But that gets us to Tuesday. There's tons of stuff going on Tuesday. You have Novartis, which is a big global pharmaceutical company, reporting Tuesday before the bell. You have some heavy hitters in the US banking sector: Morgan Stanley, Charles Schwab, Bank of America, Interactive Brokers, huge businesses both on the commercial side, the investment side, the brokerage side that are reporting. You have Prologis, the real estate wing, some other financial companies. So Tuesday, we're going to get a really nice combination of stocks reporting. We also have Lockheed Martin here, which will be really interesting to see their sentiment. So let's get into some of these stocks on Tuesday. We'll start with Novartis. So Novartis is up 20% in the last year here, performing really well, $225 billion market cap. When we look at their revenues just quarter over quarter and over time, it seems that they have been steadily increasing their revenues over the long term. Their income's been a bit more volatile, as it usually is with these pharmaceutical companies. But looking at their earnings per share estimate, they're right around 670, which puts them right around about a 15 times, which, for a pharmaceutical company, I think is fair. They have probably some patents expiring. They have some promising innovation for new drugs and new products coming up. I'm not too close to company by company who plays in what space and what they do and where they are in their pipelines in terms of patents and new products. But overall, I feel like a mid-teens multiple is very, very in line with what the sector tends to be valued at for pharmaceutical drugs. So I think this one's fair. Probably one that could go up if they have a great earnings report, also could go down. Probably stating the obvious there, but I don't really have a strong opinion either way on face value on this one. Going into another stock that's reporting on Tuesday, Morgan Stanley here. Morgan Stanley's had a pretty good year over the last year, up 9%, given what has happened in the banking sector, especially earlier this year with all those bank calls on regional banks. That kind of had a ripple effect through the market. But as we look at Morgan Stanley, paying out a 3.6% dividend yield, currently trading at a 15 times trailing earnings multiple. If we look forward at what their earnings are expected to be, it's about $6 a share, which really puts them at about 14 times trailing, like we saw. But then in 2024, they're up to 750 a share. So that gets them closer to 11 to 11.5 times earnings on this one. That's more what we tend to see in the rest of the banking industry. So maybe they had like a one-time capital expense or write down on their business that artificially increased their price to earnings ratio. But overall, seems like this business is trading at a really reasonable valuation for the size company and the ability to deliver value that they've shown over the long term. So this one will be really interesting to see how it performs. In the meantime, you're getting that 3.6% dividend yield, which is pretty nice for a US bank stock as well. So keep that in mind when evaluating whether or not you want to start a position in that stock. Going on to Charles Schwab. So I actually indirectly own a piece of Charles Schwab through my rather large TD bank position since they merged Ameritrade, I believe. So a percentage of the business is in Charles Schwab stock. Looking at the business here, they're paying a 1.7% dividend. in the last year, they've been slightly down here. Looking at their earnings per share estimate, it's at about $3.20, going up to $4. So $3 on Charles Schwab gets you to about 19 times, later on to 20 cents. So they're probably trading 17 and a half, 18 times earnings for this year, expecting to grow that next year. But I've always found it interesting that the brokerages trade at a higher multiple than lots of the banks. I guess less exposure to debt and credit losses from loans and stuff like that. But I've always found that interesting, especially the moat that some of the banks' revenue streams have on them. The fact that these brokerages just trade at such a significantly higher value has just always been something that's amazed me to a certain extent. Still on Tuesday here, Lockheed Martin. This one will be really interesting. Obviously, with the wars going on around the world, lots of governments stocking up. Over the last year, Lockheed is up 20%. In the last 5 years, up 44% there. Pays a 2.6% dividend yield. Looking at their earnings per share, up to $27 this year. So if I just times that by 20, it gets me to 540. So they are trading significantly under a 20 price to earnings ratio given uh, the analyst forecast for this year. They're actually probably trading closer to 16 to 17 times. So not a bad valuation. Maybe consumers and investors think this may be the top of military spending and it may just go down from here. That is to be seen. So we'll see how that plays out. But definitely a unique and interesting stock to just keep in mind. Going on to Tesla, which was actually Wednesday. So I'm going to pivot over to Wednesday in this chart. A lot more big stocks that you can put on your watch list for Wednesday. You got Goldman Sachs, you got US Bank Corp, some other financial stocks like Ally, M&T Bank, Citizens Financial Group, etc., that are reporting. But you also have some nice tech stocks sprinkled in. Netflix will be super interesting. They recently launched their ad tier. Their stock has just doubled very recently. So we'll see if they can kind of defend that move or if the stock may revert to the mean a bit. Tesla's gotten moved all over the place from $200 down to $100, now up to $300. So similar to Netflix, we'll see if they can back up that stock price rip in their report on Wednesday. You got IBM. Should be interesting to see what they do. Las Vegas Sands, another one there. So let's just get into some of these Wednesday reporting stocks. Starting with Tesla. Tesla just over the last just year to date, 6-7 months, the stock's up 160%. The stock is so volatile. If you just look at it this way, this move here down to here, that's a $1 trillion company essentially giving up 70% of its value. Just unbelievable volatility given the size and the amount of money in this company. Looking to their earnings report though, so companies trading at $281. They are planning on earning about $3.50 in the entire year. So on that, they are really trading at about an 80 times current year earnings. If they can somehow get the $5 next year, I know there's a wide range on analyst expectations, but if they can get the $5, then they'll be trading in the mid 50s next year. So still super high valuation, both for this year and for next year. It's an area that, given the valuation and all the other circus around the stock and Elon Musk, I personally decide not to touch this one. I never have. I've obviously missed out on an opportunity to this point, but I'm not planning on jumping in here. Next stock that we talked about for Wednesday is Netflix, and similar to the prior stock, this one has ran a lot this year, up 50% on the year. But as we look at the last 1 year, they're up even more, up 131%. So this one really just cratered down from $700 to $150, $160, and now it's just getting huge gains because the risk reward was so low at that point. And now you're just getting huge gains from there. If you bought, you're up another 150%. So there's a huge buying opportunity. We'll see what they say about the writer's strike, the actor's strike, which may disproportionately hurt a business like Netflix as they fight for attention with consumers. We'll also hear what they say about the advertising tier of their business, about the paying to share your account with friends protocol that they recently put into place. There's a lot of revenue drivers going on this business right now. So it'll be interesting to see just how they talk about that and how good they are driving scale on those incremental dollars that have the potential to come in. Looking at earnings, so Netflix seldomly trades on earnings, but they're expected to do about $11 this year, which would put them at about 40 times earnings. And then for next year, they're closer to $15, which would get them right around a 30 times earnings. So 40 times current year, 30 times trailing. But they don't really hold themselves to their EPS too often. They really are looking at driving users, driving average price, and then as long as they're creating value for consumers, the EPS will come is kind of how they generally talk about it. So lots of the times they've missed earnings bad, but the stock roars off of subscriber growth. Be interesting to see how that one plays out. It can go in a lot of different directions. Okay, I think we're still on Wednesday here. We are with Ally stock. So Ally Financial, this is one that I used to always think looked cheap. It's at $40. It was trading at 6-7 times earnings. But this is just a good lesson that things are not pricing in what's already happened, it's pricing in what's going to happen. So on Ally, stock went down to 27 bucks, actually went down to the low 20s at one point, still trading at a moderately lower valuation than what it was from a price to earnings multiple when it was $45. So just because a company earns money once doesn't mean that they're entitled or they're guaranteed to earn that money year over year into the future. Ally's a good example of that. With that being said, the company's still trading super cheap. Looking at their valuation here, $3.44 for this year, which would make it about 8 times, $4.80 for next year, which would make this stock extremely cheap if you were to look at it from a multiple standpoint. Discover Financial Services. This is call it like a pseudo bank. They really focus on credit cards for lower income consumers. They actually hold the debt themselves, make money on the accrued interest, assuming consumers pay them back. Looking year to date, this one has gone up so much, especially when you relate it to their category, where stocks like big banks and such have gotten hit at least 10% plus. Discover Financial is up over 22%. They also give you a nice 2.4% dividend. Looking at EPS on this name, expected to be around 13 and change over the next couple of years, which would get their price to earnings ratio here at about a 9 times current earnings. So good opportunity to generate 11% free cash flows on your investment there. It just is a bit uncertain where that investment is going. Okay, NASDAQ. So lots of you may not know, but NASDAQ is actually its own company. They own the exchange. They get revenues from companies who are listed on the exchange every quarter, probably a very small percentage of their market cap, like we're talking a couple basis. They may make money on trades. They make money on research, on information, on data. So it's an interesting way to play the NASDAQ in general. The exchange is only worth about $25 billion. They pay a 2% dividend yield, and they're currently trailing at about a 22 times earnings. Looking forward, because that's why we're here, they're expected to do about $2.75. So a bit under a 20 times earnings situation, probably about 18 times off the top of my head. You can buy NASDAQ Inc. at right now. This is one that I actually am interested in. They have a big moat, only so many exchanges that get taken seriously. They are one of them, and they have a lot of opportunities to grow their services to their clients, which is essentially like Fortune 500 mega companies. So I think for a market cap of $24 billion, there's lots of opportunity here for NASDAQ. And going ahead to Thursday, I'm just making sure I am not jumping ahead too much. I still wanted to touch on Las Vegas Sands for Wednesday. So I have recently started buying shares of Vici Corporation. So it's always interesting to see just how Vegas is doing, how their tenants are doing. Hopefully they're doing well, and they say good things with the Vegas consumer. I just want to show like the 5-year chart. These companies have still not fully recovered, despite this almost double up in the stock that we're seeing over the last 6 months or so, 6 to 9 months. The stocks are still down pretty dramatically versus their all-time highs. Vici, which is the real estate arm that owns all these businesses, at least most of them on the strip, has been doing exceptionally well. So I'm just going to keep an eye to make sure that still holds. Good thing is the company's expected to be profitable. Last year lost a buck 20 on the year. In 2023, expected to be about $2 profitable, so trading about 30 times earnings. Next year they're going to do $3, so trading at 20 times earnings. At the end of the day, I'm not paying 20 times earnings, forward earnings, for a Las Vegas casino company. I'd much rather own the real estate and cash yield 5% as I wait for capital appreciation on that one. So I'm not too interested in Las Vegas Sands. They are reporting here this week. For those who are, let me know in the comments if you like or own that stock already. American Airlines. So I've talked about Delta a bit over the last number of weeks. American's also done super well, up 43% year to date. Really good sentiment about flying and just the unit economics and the demand for their business. Looking at their valuation, expected to do about $3 this year, $3.30 next year. So how that translates is about a 6 times earnings for this year, about closer to 5 times earnings for next year to buy the airline. I have no idea how much debt is on their balance sheet, probably a lot since they just came out of COVID. So that may be draining the multiple a bit in terms of what the equity's worth. But really interesting opportunity in the airlines that I'll keep an eye on as we get down the stretch here. J&J, Johnson & Johnson, is trading at a $415 billion market cap. I believe they just spun off their consumer health division that owns things like Tylenol, so on and so forth. So we'll see how that all pans out. They still own 90% of the stock, but it's in a separate company. Pays a 3% dividend here. Looking at EPS estimates on this one, $10.65 this year, up about 5% to $11 next year. If I was just to take that back, it equates back into about a 15 times multiple this year. And then I forget the number for next year. 11. So next year would be closer to a 13.5, assuming the business does just as well. So best of luck to everyone who owns this stock. But this is a stock that I personally haven't owned before. I know they had some lawsuit risk on their consumer products business. I think that's one of the reasons why they separated it out. I'd love to get into this one if it got to a very attractive valuation and a great starting yield. So it's one that's on my watch list. I hope you guys who do own it do well with it this week, but I do not own this stock directly. Continuing on some of the future days here, on Thursday, we have Intuitive Surgical. It's an interesting stock that supplies like med spas essentially. I've been looking at that stock. I've been looking at InMode. Haven't bought any of it yet, but I think it's an interesting opportunity to jump onto the earnings call. And then lots of other names that I'm not really going to talk to today, like Abbott, DR Horton, some other banks, so on and so forth, CSX, Capital One, Taiwan Semiconductor, lots and lots of businesses. We can be here all day. But I choose to talk about Intuitive Surgery today. $124 billion market cap. I was shocked by the size of this business and how much it's running, over 70% in the last year. As I go to year to date, over 30% already this year, over 100% double up in the last 5 years. So lots of interesting valuation work being done on this stock. Looking at their earnings per share, about $5.50 this year, $6.50 next year. So just looking at what that means, it pretty much means that the stock's trading for about 60 times, give or take, earnings. So super, super expensive stock. I don't fully understand why InMode trades at a 17, 18, and Intuitive Surgical trades at a 60. Just more lack of industry knowledge on my part, and that's part of the reason I haven't really invested in this space. But one I'm going to keep looking at, continuing to monitor as well. And going into Friday. So on Friday, we have AutoNation, IPG, a couple other businesses, but I'm really interested in Amex. I do own Visa. It's one of my favorite positions. I think Amex is a fantastic company as well. Looking at their market cap, they're at about $128. In the last year, they're up over 20%. Like lots of the card companies, they've outperformed the market. They're expected to do about $11 in EPS this year and about $12.50 next year. So if I go back to their share chart, $11 this year would get them at about a 15 to 16 times multiple, and then at $12.50 next year, that gets them that would get you closer to a 13 to 14 times multiple. So good valuation for a company that I think still has lots of tailwinds, lots of opportunities in the market to drive top line, drive bottom line. Gonna keep an eye out for what they report. Somewhat interested, but also want to get a sense of how Visa may do this year. So, or this quarter rather. So I know I was talking quickly through that just because there's a lot of stocks. I don't want to make you guys listen to me for an hour here. So I just tried to go through that as fast as possible. If you like this type of content, be sure to subscribe to my channel. Give this video a big thumbs up. These videos do take a lot of work, and I really appreciate those of you who stuck around to the end. So let me know in the comments, and be sure to give me a thumbs up for the YouTube algorithm. And I wish you guys all good luck in the market this week. It's crazy this week. It's earning season, one of the best times of the year. So try to enjoy it as much as you can, and I'll see you guys in the next one.